No.
Hi, good afternoon, everybody. I hope I'm audible.
Yes, we could hear you, Ravina.
All right, great. I'll request a small request, please. If everybody could please switch on their videos. It'll be really great if you could switch on your videos, please. We have here with.
Hi, I'm sorry. I'm accessing it from my office desktop, and we don't have cameras.
Fair enough.
Yeah,
sure. Whoever can, whoever can, able to on their videos, that is fine. I'll just repeat. I'm sorry, I was on mute. We have here with us on the call Mr. P.S. Reddy, Managing Director and Chief Executive Officer, Mr. Satyajit Bular, Chief Financial Officer, and Mr. Praveen DG, Head of Investor Relations. I'd just like to please inform you that this call is being recorded and will be available shortly on our website. We'll begin. Can we begin, please?
Yes.
Like to introduce yourself?
Yeah. So hi, I'm Lavanya, and maybe we can start our session. This session would be a Q&A session largely, but I would request management to just give a small brief on the current business scenario, maybe on how the volumes of futures and highlight how the volumes of futures and volumes are options.
Sure.
Yeah.
How many participants are there? I see cameras on for 4. Session is going to be displayed on the website as per the LODR requirements. So it seems it's good to have everybody introduce themselves so that it gets recorded.
Okay.
Please ask each one of them to introduce.
Sure. This is Shaleen from UBS as well. Awesome.
Okay, next.
Hi, you've got Patrick Goodell from Ashmore here.
Hi, this is Sean Pompa from Kane Anderson Rudnick.
Hi, this is Prakriti Banka from HSBC Asset Management.
Ilotpal from HSBC.
This is Madhusudan from UBS.
Yes, Mr. Madhusudan, we are not able to hear you.
So it's Madhusudan from UBS.
Thanks, Lavanya.
Yeah.
Anybody else?
So besides that, we have operator who basically the system operators here, and Kian is from the UBS marketing team. So basically, they're managing the system, not the industry.
No problem. Thank you for this call. We will brief you as to how we have done over the year. As you've seen, sorry. In the FY 21-22, we have a futures turnover of 26,000 crores, and options for the entire year put together, it was about 7,800 crores. But then options, if you take into consideration only the last 2 quarters, it's about 15,000 crores. That's the kind of growth we have seen. And probably you are aware that we started charging on options from 1st of October onwards. And so thankfully, we have been able to, catch the momentum at the right time. Having said this, yes, the bullion has contributed about 43%, and the energy has contributed about 32% to the business, and metals is 24%, and agri is less than 1% in terms of ADT, their contribution to the ADT. And as compared to the last year, bullion contributed 61%, that is 2021, and energy has contributed 18%, and metals have contributed 20%. Again, agri is less than 1%. So this is the kind of trend that we have seen it. And having said this, the major contribution came from energy in terms of options. And in the options also, the crude oil options has been doing well from the second quarter, third quarter of 21 to FY 22. But NG we had introduced sometime on 17th January in the last quarter. And today, of course, it's more than beyond a quarter. If you see, it's almost all 3,500 crores ADT notional value. Currently, we are seeing it. So these are the few numbers that I have, and we have got some new contracts also approvals, especially one monthly options in gold on the underlying of bi-monthly futures contract. So that is something which we hope to do well because the premium will be reduced, will be halved. That's the way it is at this point in time. And we have also introduced sometime the options on gold mini, and that is also working well at this point in time. About 70-80 crores ADT. All these figures are available on the website, and that's the way it is currently working. There are many other new products which are in the pipeline, which are pending for approval of SEBI. As and when we get them, I'm sure you will see some growth in these verticals also. Thank you. I think I will ask I will leave the floor open to the participants to ask questions.
Hi everyone. So maybe you can just use the raise hand option and I can moderate. Please go ahead, Patrick.
Hi. I'd like to ask about what the major new product approvals you have waiting are, and which of these could be a meaningful driver of ADTV going forward.
Sorry, I couldn't understand. Could you please repeat?
Yes, looking for details of the new product approvals you have waiting at SEBI. Which of the major categories you're waiting in, and what their contribution to ADTV could be.
Well, I can't give the projections on those products, but then I can give you the products. One is the steel TMT bars is one contract. Electricity derivatives futures contract is the second one. The third one is the aluminum alloy. These are the three contracts. There are options. We have also asked for not options. We have asked for a futures contract, a fortnightly gold futures contract. Okay, that's another contract which we have asked them. So these are the ones pending at this point in time.
And for the electricity derivatives futures, what's the timeline of that being introduced, and how do you look at the total market size there?
Well, while the market size is very big, no doubt about it, but then it's a highly regulated market at this point in time. The discoms are all within the fold of the state governments, and the discoms are within the fold of the state governments. Gencos are also largely of the government, and a lot of this market works on bilateral trades and maybe a long-term PP, power purchase agreements. I think gradually it is opening up. Today on IEX we see almost 10% of the demand is routed through the power sector. Demand is routed through IEX, that is Indian Energy Exchange. So I think we are seeing a good growth here. But what came as a surprise at this point in time is that there's a cap on the pricing, even on the IEX that the government has imposed. So that is the kind of thing that has come. But the government is keen that the power sector is liberated, and more and more trading takes place via these exchanges. At least the consumers and producers should be able to hedge their the pricing, the remuneration that they get for the products that they manufacture, or the kind of consumers for their energy costs. They can cap them by hedging on the exchanges. So there are a lot of what you call engagement with the stakeholders has taken place, especially with the discoms, gencos, and the major industrial consumers. And at this point in time, yes, CERC, which is a regulator for electricity spot, is looking into it, because there is a joint committee of SEBI versus C and CERC. They have to approve this. I think it may come any moment now. I think enough time has elapsed, and now they are keen to launch it.
And will the trading fee you have on electricity derivative futures be the same as your other products?
That's right. Same. No change.
Okay. And then you started charging for options recently. Is the price you're charging for options going to be flat, or is there room to increase that further?
Yeah, there are two slabs which we have currently, and one slab is up to 5 crores of average daily turnover, the premium turnover. It's about 50 rupees per lakh premium value. And on incremental, that is a slab of over 5 crores, it will be 40 rupees per lakh premium. Is that clear?
Got it. Clear. And
two
then,
slab. Circular is already there in the public domain.
Okay. And then what other measures do you have in place to boost trading volumes of normal kind of commodity futures? Because we haven't really seen them get back to the levels they were prior to the change in margin requirements. So what kind of initiatives have you got to try and get volumes back to where they were before?
I understand that point. In fact, we were earlier having a 31,000 crores ADT of futures. Now that has remained at around 26,000. And we are hopeful with the increase in options contract, maybe option writers will also secure their position in the underlying futures. So I'm sure there will be they complement each other, these two products. That's the way we are looking at it. And as regards to the margins, yes, that remained as a dampener. But recently, SEBI issued a circular saying that the margins can be even whatever is the end of day, whatever they paid the previous day, and if there is no change in the position, probably the same margin is valid until they change the position. So what I'm saying is, earlier when the peak margin circular was there, even if I have let us say 100 barrels of crude oil, now I don't buy anything additional, but if the prices keep going up or down, whatever it is, then are going up, I need to keep paying margins on that also during the intraday without changing the position. So that has been put to rest. Probably most of the hedgers, what they do, they just take a position and leave it at that, and they pay the margins. And on a day-to-day basis, they settle the M2M. Now, when the peak margin came in, the problem is that even at light night, 11 o'clock also, I may get a call to pay margin, although there is no fresh trade on that position. So because the prices have gone up. So that kind of situation does not arise. So that has offered some relief to the market participants. So this is the kind of things that have happened. But most of the prices have gone up. As a result, even the margin in terms of absolute number has also gone up. All the percentages may have remained the same.
Got it. And so that change to peak margin requirements, so that it doesn't apply if there's no new position, when did that come into play?
The thing what I told you?
Yeah.
Just in this month only, in May only, I will pass on that information. Check that from somebody. Please ask. Weight of the circular. What else?
Okay, thank you.
Thank you so much, Patrick. I request the participants to raise hand for any questions. Please go ahead.
Yeah, hi. Thank you for taking my question. I just wanted, I mean, you've gone over your, the change in your software provider a couple of times. Can you just again, mention when will this happen? And again, the contours of the deal in terms of what may be the initial investment and what might be the ongoing expense incurred on that front.
So what?
The move to TCS as your software provider.
Oh, okay, okay. Yeah, I will tell that. You see, the May 11th is the circular, Mr. Patrick. 11th May 22, the segment has been, the circular has been issued.
Thank you.
Thank you. Yes, on the TCS platform front, madam, the work has started. Now it's in full swing. We have already gone. We have already launched few modules on a mock on mock platform, and some more modules will be released. In the next week or so, 10 days, and we have a time till 30th of September to go live, and we propose to go live maybe at the end of August or early September. And the cost part of it, it is a pretty delicate one because confidentiality agreement clauses are there. All that I can say is currently we are paying 55 crores CR or 55 crores depending on the volume. If volume increases, that will go up unlimited because there's a how much 12.5% sharing. What is the? You can tell me, no? Yeah, 10.3% on incrementally on whatever the growth that we see, we have to pay them. That kind of clause is not there with TCS. So that there's a cap. There's no such thing. There's only an AMC. That AMC is also fixed upfront for the next 5 years, and at this point in time, it is a single digit. So at this point, as I'm speaking, maybe first 1 year we will get a warranty period services, and thereafter the AMC kicks in. The second part, if it is, although the AMC is very little, I'm sure the depreciation allowance will be relatively high because the assets will be depreciated over a period of 7-8 years or 8 years. 8 years. The second thing is there are also AMCs on the applications which are third-party applications. For example, be that IBM or be that Linux, Red Hat, etc., etc. All those guys will charge some AMCs, so that we have to factor in. So maybe after September we will be figuring out. Maybe in the month of December quarter, you will really come to know on a quarterly basis what is happening on this front, and probably you will get a figure out there.
Okay, and in your previous thing, you just mentioned all of these other service providers also you need to account for additionally. Previously, this was all clubbed together in that 55 crores that you were doing, right?
55 crores is again, as I said, there is 15.6 crores is the fixed component,
Sure.
and thereafter on the volume based, that is minimum of 15.6,
Okay.
and 10.3 is on the
Got it.
on turnover.
Sure.
Based on,
Got it. Okay. Okay.
there's no limit on it.
Okay. Also, in terms of bringing new participants on the platform, I mean that's also been a bit flattish. Any developments on that front that could just bring new participants on the platform?
Yeah, I know. We are hopeful that SEBI conclude this FI participation into this sector also at the earliest. And I think they have issued a public consultation paper, and then many have responded. and they will take it to the board maybe sometime next meeting or whenever that is being held. So we are positive at participation. As regards to mutual funds, we are making a lot of efforts and a lot of it's lacking focus, I would say, on the part of the mutual funds. So we have shown to some of the arbitrage funds how they can make money and where the opportunities are there based on a 3-year data. And some have looked at it, and then one or two have started also. It's not that they have not started. And about 4 of them are participating currently, and some of them are concerned about some clarifications that they needed. For example, SEBI circular says when they issued a silver ETF, the bar should be 30 kgs. There's no deviation. But actually in the market, you won't find 30 kilo bar. It's just a plus or minus 2.5 kgs kind of thing. So that tolerance limit is what we have kept, and that they have not, SEBI has not kept it. So this kind of issues we have taken. Similarly, the gold delivery, gold 1 kilo bars, they have to be necessarily LBMA gold. That's another thing that they have mentioned it. So custodians say, no, I will not accept anything other than LBMA. That is fine. Currently we have only LBMA, but then Indian government under Atmanirbhar Bharat, we have empaneled, after following strict due diligence norms, some of the domestic refiners also. Okay, so they are also eligible to deliver, and so SEBI has to relax that condition on that. So these are the issues, some of them which are there, and we have also told AMFI that they should have a what you call an advisory committee within AMFI on commodities. Then the focus will start coming. Otherwise, this will not be there. So I'm sure. It's work in progress. I would say it's not concluded as yet. We will bring in. But as regards to the lot of, I would say, as regards to the hedges participation, a lot of industries are participating. That number is seeing it. I'm very happy about it, and that's the way it is at this point in time.
So in terms of hedgers, can you sort of put that percentage or the kind of growth that you've seen, some figure on that?
Yeah, you see, for example, our cotton, in fact, it has become a big controversy. MCX is prices are determined, and then there's a speculation, and they should be banned contract. But then we have put up a big circular, a press release informing the market participants what is kind of percentage of participation that we have, and how much open interest that they have. Almost all 50% in cotton contract open interest by the hedgers. It varies from, and we put up on the website, by the way, every month the participation in different contract. It varies, of course. It varies in different contracts. For example, gold and metals and silver and the hedger participation, and agri also. Hedger participation very high. And crude oil and natural gas, it is relatively low. I say relatively low. This is a self-declaration basis, and it just don't bring volume. Please appreciate that. They only take a position, and open interest is contributed by hedgers. Okay, they don't churn the trades. Buy, sell, that. So, but they buy it, and then they stay there for about a week, 10 days, whatever is their requirement, and then move out. That's the way it is.
And for hedgers, you said in gold, silver, etc., their participation is quite high. So how has that moved? Say over the years, has that increased? And have you done anything for that to increase, or is just, what's led to that?
See, there are two things. The more the volatility, the more they seek cover. Now, currently, gold and for especially gold, they can't go on to overseas markets and hedge. That is what the government RBI rule is. Okay, so they have to necessarily perforce have to come to the MCX and then hedge. So the more the volatility, the more it works.
Okay, so you're saying the increase in hedgers is only at this point of time. It's not a structural change. It's more of function of volatility.
Yeah, functional volatility has always been, not just today.
Right.
Any effort you do it, ultimately volatility only drives them. The CFOs should wake up and then know tomorrow morning. I mean, my balance sheet may be disturbed if I don't hedge. That's the kind of sense they should get.
Okay. And is it this, broadly the number of contracts, is that the correct thing to look at? If you see that, say, since 2015 to 2021, before, say, last year has been obviously different because of this peak margin rule. But in those many years, if you see the number of contracts, traded has not changed very much. So
It is not changed because of, again, peak margin effect has been there, but there are a lot of shift has taken place towards the options.
so I'm saying that is only in, say, this last year, right? That's been affected by peak margin, and you've seen movement in options. But otherwise, why has this number been so stagnant?
I mean, is it stagnant over several years, or is just?
I was just looking from 15 to 20 in the last about 5 years before this.
Yeah. We had in 2019, there is what's called mini contracts. So mini contracts have gone. Now we are looking at SEBI to introduce them. In fact, as I'm speaking, there's a meeting tomorrow in SEBI, SIDAC meeting, and our proposal to introduce mini contracts is also there. So today, for example, the nickel contract value is how much? It's almost 30, 35 lakhs. Now, what's the margin? Maybe another 15%, 20% of it. Now, it is too big a contract for participants to step in. So we are requesting that a mini contract should be introduced. So more will be able to participate.
Okay. And this you said you had mini contracts till 2019, and why did you discontinue that?
SEBI asked us to discontinue.
Sure.
There are three structural changes that have taken place. And one is that they wanted trading lot and then delivery unit to be identical. Second thing is all cash settles contracts have to be done away with it, and it should, except was crude oil and energy. Crude oil, this one. Their cash settle is permitted, but metals I'm talking about. And the third, the multiple contracts should not be there. Only one. The reason is that it will fragment the liquidity. But I mean, we have seen now in the last 2 years, so many UCCs have moved out of it, and many people have returned to SEBI also. Now they are relooking whether these two multiple contracts reinforce each other or whether they crowd out each other.
Okay. All right. Thank you.
Thank you, Prakriti. So we have a question from Madhu from UBS. Please go ahead, sir.
Thanks, Lavanya. So just continuing on the same question which was being discussed. So we have seen a period of very high commodity prices, and the user industry has obviously burned their fingers because a lot of them did not kind of, either foresee or hedge those positions. Wouldn't this be a massive opportunity for MCX to go out, have an outreach program to all the guys who are using all these commodities and explain, like, why you exist, what they could have done to kind of, hedge their positions and save their balance sheets and P&L. Can you explain a little bit, like, what's your marketing team doing? How many people are there? How many people have you reached out to? Is there a big outreach program? Because, earlier on, like, 3-4 years ago, when we were speaking with a company, it seemed like, if volatility is there in prices, then a lot of business will be written. Just seems like that didn't happen this time.
Yeah. See, we have conducted almost all 1,200 plus investor awareness programs, notwithstanding the COVID and restrictions, all that. Most of them taken place are webinars. Okay. Now we have also introduced a program to train the CFOs in this derivative segment. Okay, many do not know how to go about doing this job. Okay, in association with the CA Institute, in association with the CS Institute, and we have conducted a lot of programs. And there we have also taken some of the market participants and not the member brokers, but the ones who have benefited by doing is, so that seeing is believing, and somebody else has benefited, they explain, they know where the shoe pinches and what they did. So a lot of effort has gone into that. Then the problem is there's a huge understanding gap. Of course, it is our responsibility to continue to educate them. They don't consider the physical book and the finance book as one, and then consider whether they made profit or loss. Once you have hedged your position, means there's no loss, no gain. But if they incur a loss here, that is in the derivatives market, and then they gain in the physical market, that's what the book's supposed to be reflecting. And because they take a contra position on the exchange, whatever the position that they have, they take a contra position. That should be the case. But many did not appreciate, oh, I lost money there, but I have gained here, and my losses got what we call offset. But it's supposed to be protecting you and locking your prices. That's all. It's supposed to be. It shouldn't be giving you more money than. That's all. Is all about hedging is. Okay. So that understanding gap is there, and that's where we are. Trying to making all efforts to ensure that that understanding gap is built, bridged.
Sure, sir. Thank you for that. And the other point was, it seems like you've had a fair bit of success on the option side. The offtake on volumes has been very strong over there. What's leading to that? Like, is this more speculative that is driving it, or kind of, who are these people who are writing all these contracts, options?
One is that this peak margin have made many people to look at options, because especially the option buyers, they pay the premium and then it's done kind of thing. They are not looking at a day-to-day M2M and then giving margin and all that kind of thing. So many have preferred that, but I do not know. I am not able to understand. At least Indian investors are always fond of options. Okay, you see Nifty options and or in equity markets, all are options, which works. Bank options, bank Nifty options, etc. So I'm not able to understand so much, but as yet rather. But then yes, there is a sense of affiliation to options than to futures.
And the what do you call, client mix would be similar for futures and options business for you?
Sorry?
The client mix would be similar?
Client mix is, we have seen on the option buyer side, whether they buy put option or a call option, mostly retail. When it comes to the other side, their prop accounts are mostly on the option writer side.
Right. Thank you so much, sir.
Thank you. So please go ahead, Sean.
Yeah, hi. I just had a question going back to the CDP. Is there any way you can disclose just kind of what the incremental, what the PP&E and the capital work in progress will kind of look like right before the new platform goes live, so we have a sense of kind of what the depreciation could look like?
Yeah, but give out the amounts,
It's confidential information as of now, so we won't be able to share it.
Okay. Okay, great.
I understand where you're coming from. Yeah, but confidential as of now.
Is that the same for trying to understand what the related incremental capex will look like?
The capex, I think as MD mentioned, there's some payments that we have to make to TCS. Otherwise, most of it we have.
The hardware has been purchased and all the commitments have been taken care of. But then TCS implementation costs are not as yet made. I mean, not as yet reflected in the accounts. Put it that way.
Okay.
That,
yeah, that's helpful on the CapEx side. Okay, and then on the electricity derivatives, maybe I'm just still trying to figure this one out, but the cap on spot pricing that was recently introduced, I'm just trying to understand how, how you could create a futures product when there's that cap in the market. How does that complicate things, I guess, is my question.
Yeah, I mean, it doesn't augur well for us with that kind of cap. So the way that we are pitching out is that you have to resort to all such things because it is. I mean, the parties have not hedged their positions had there been a what to call orderly derivatives market, probably such kind of fluctuations, volatility would not have taken place in the spot markets. We have given research studies also to buttress our argument. So if an orderly derivatives market is there, even the spot markets also behave orderly. That's the way we said that. And it is a knee-jerk reaction on their part, and maybe it's a political economy decision rather than a pure economic decision.
Yeah, I guess do you view that as maybe being a temporary solution on the part of the government, given all the volatility in spot pricing, or is it hard to glean, whether they do view this as being a long-term political solution, I guess you call it?
Yeah, it's not long-term. It's not long-term. It's just, as I said, it's a political economy decision.
Okay. And then the other question I had is on, there was some mention of the CME royalties on I guess it's on crude and natural gas contracts during the call. Is that royalty? I guess what's the structure of that royalty kind of percentage of those trading volumes, and is that showing up in the software and product license fees expense line?
It shows up in that fixed cost, or there is a product related cost. Yeah, it is there. You can speak. And it's like this. Our contract with them is a calendar contract that is from Jan to December. And Jan to December, there's a minimum fee and a variable fee. Now, we have not exhausted that within that minimum variable fee, whatever we could trade, but then we have not exhausted that in the year 21. That is till December 21. But in the first quarter of the calendar year 22, our volumes have picked up substantially. So we ended up paying little more than the minimum. Yes, please explain.
Yeah. We made a provision in our books for the amount payable to CME, and when we come to the end of the calendar year, then if we have, there's a minimum that we have to pay to them. If we cross the threshold, then we'll pay them the additional amount. It's 20 lakh US dollars that we have to pay them on an annual basis.
Minimum. Oh, sorry, can you repeat that last part?
The minimum amount that we have to pay them, 20 lakh US dollars.
Okay. Perfect. Thank you.
Thank you. So I request participants to raise hand if there are any questions. In the meantime, maybe, sir, I would request to update on gold exchange. So there was an issue on GST related thing. So when do you expect it to resolve, and when you expect to launch gold exchange?
See, the two things. One is the gold spot exchange is what you may be asking about, domestic gold spot exchange.
Right.
Now, in the domestic gold spot exchange, we are yet to get our application ready. That application we have development is again with TCS. Once the TCS complete its delivery in the mock complete delivery, which I said in the next 15 days to 20 days, maybe. Probably we will be able. They will pick up that stable code and then develop for the spot. Now, having said this, this is our preparedness. So we may launch sometime in February, March, maybe next year. Once God willing and everything goes on well at that point in time. Now, why? Generally speaking, why the gold spot exchange is not launched neither by BSE nor NSE is there is a GST issue. The gold spot exchange, what is traded there is electronic gold deposit receipts, EDRs, what is they called it. Now, EDR is classified as a security. The moment you call it a security, there is no GST payable. But to convert something into EDR, the first guy, whosoever is depositing or whosoever is converting, he has to bring the physical gold and then put it in the vault. Now, they look forward to get the what you call input tax credit. Now, they will not get the input tax credit because they converted into EDR, and until the EDR remains in the system and until the last person takes it out and converts into again physical gold and withdraws it, the first depositor will not get the GST credit. So it has become a non-starter because of that. I mean, it's a blessing in disguise for us because we don't have a platform. So it is getting delayed to that extent.
Okay, got it. Thank you, sir. And on the, just a clarification on my side, is that gold MCX is empaneled with some of the domestic gold refiners, but delivery is still by LME, or even the domestic refiners are delivering currently on the platform?
It's other way. It's not that we are empaneling somebody. I mean, rather those refiners are empaneled by us after following a strict audit procedure. Okay, much the same way like LBMA. We have an international, Alex Stewart or maybe Bureau Veritas Inspectorate, etc. They do the audit of the systems and including they go to the extent of identifying which of the crucibles they are using, equipment they are using, whether they have a fire assaying or any other type of assaying, etc., etc. Our detailed document is on the website, and after going through all those requirements, they will give the certificate. And then we also do a financial audit of those firms separately, independently by in the external CA firm. And then we have a BREC committee with a brand approval committee. So we will take it to them. Once they approve it, then we will do the empanelment. So far, four of them have been done, and maybe one more will come soon. That is Titan, Industries. So their refinery is also empaneled. Maybe once the agreement is signed, then we will be allowing them to deliver on the exchange platform.
So currently all the ones which are empaneled are delivering on the platform, right?
Yes, they did.
Okay.
They have.
Got it, sir. So we have last few minutes of the session. I request the participants to raise hand if there are any questions. Sean, please go ahead.
I just had a follow-up on the gold exchanges. Can you give an update on the international exchange at Gift City?
International spot exchange, bullion exchange, is that what you're asking?
Yes, sir.
Yeah, sure. See, the BSE, NSE, and MCX and two depositories, NSDL and CDSL, have come together and set up an exchange and a clearing corporation together. And we have also a depository which was set up by CDSL. We have taken over. So because they want only one entity to work. Now there, the developments are that say, IFSC and RBI and Director General of Foreign Trade has now permitted the uh, jewelers of a certain size to directly import the metal instead of going through the channelizing agencies uh, and take delivery from IIBH, provided they do the trading on the IIBH. So that is the development. We have done the soft launch. It is to be formally inaugurated, and some bank related issues are there, and as to the transaction kind of thing. So once that is also resolved by RBI, I think it will be up and running with full steam. Maybe we'll fire on all cylinders. That's the way it is. And because we are a major gold consuming country, almost all 800 to 1,000 tons is the consumption. If that is the case, a huge amount is getting imported. And instead of having it priced in London, probably some of those participants who are selling the gold bullion banks will also start coming down and then selling it maybe via the banking channels. So this is what at this point in time is.
Thank you.
Thank you. So we can take one last question if there are any. Okay, so maybe I'll ask that, sir. So do you see any regulatory headwinds over near term, or we are over all that and peak margin and all this is in our base? So do you see any other regulatory headwinds over near term?
From 2nd of May onwards, the SEBI has also implemented one is that client level margining system. That's also a very detailed one, where each client, whatever margin that he gives to the member broker, that should be reflected in the books which they are uploading on the exchange platform. Today, that while they are uploading it, SEBI also permitted them to take it into their books in the sense as if it is the members' total proprietary, but the client should be given enough exposure as much as that margin calls for. So that is what is happening. But going forward, even at the exchange level also, maybe we have to restrict the exposure to the client based on the direct margin that is given. And maybe 2 months down the line, some penalties also will be imposed if that kind of bifurcation is not given. So this is the only thing that I see, maybe negative side of it. But positive side is, as I said, FIIs, entry, maybe mini contracts permission, and launching more products. I think that works, all of them.
Got it. Got it. Thank you, sir. Thank you so much for joining us. Thanks, everyone.
Thank you. Thanks to all of you.